Hey guys, how's it going? It's Andy from Magoo Investing. Happy Wednesday. I keep thinking today is Thursday. Yesterday we had two really interesting earnings reports that I wanted to talk about. One has to do with Gamestop, a stock that has become synonymous with the newer investors and a lot of the momentum trades. And so I'm sure a lot of people are very curious to hear my thoughts on it, so we'll talk about that. And then I'm also going to be talking about the Adobe earnings report that happened yesterday because Adobe is the most recent addition to my portfolio. And if you want to see my full breakdown of why I decided to buy in, I'll link that above right now. But both of these companies came out with their earnings reports. And it was very fun to just kind of sit there and watch CNBC yesterday and see the numbers come in because GameStop was probably the most anticipated earnings report so far of 2021. And it was very interesting to see the numbers that came out and what they talked about and specifically what they didn't talk about. So we're going to be discussing that in today's video and explain why one of them was down 15% and why the other one was completely flat on the day. I will disclose that I do own shares of Adobe, and I currently do not own any shares of GameStop, but I have owned it in the past 3 months. Also, this is not financial advice, and let's get right into it. So I'm going to start with Gamestop stock because I'm assuming that's what most people clicked on this video to see because GameStop is an incredibly popular company to own right now and Adobe not so much, but I feel very strongly about Adobe, so I will put that in this video. But GameStop was down 6.5% during the day and then fell almost 15% after hours down to $154. And so far today, when I woke up, the stock was down to around $140 and now it's back up to like the 150 mark. So it seems to be holding on to its value relatively well. One of the worries was that after the massive short squeeze, we had this earnings report, and if the numbers weren't as good as maybe some people had hoped, there might be a lot of selling. And I'm actually pretty impressed that the stock has been able to retain a lot of its value, even though the earnings report wasn't as good as maybe people anticipated. This is the first earnings report that's happened since that short squeeze, and I was really hoping that the company would discuss some of these stock movement over the past couple months, and surprisingly, they didn't mention it, and that's not the only thing they didn't mention, but we'll get to that in a little bit. But I want to talk about some of the important stories that have been going around GameStop for the past couple months besides the short squeeze, because obviously GameStop is a company that's in a really tough spot. That's why you got into the short squeeze situation in the first place, because a lot of the hedge funds were not too bullish on the company overall and decided to short it. And so this is a company that has been really struggling over the past couple years. I put up the revenue chart and you can see that the revenue has been shrinking since like 2015, 2016. This is a company that needs to go through a rapid restructuring to get back on top and have actual success. One of the biggest problems that they have is that they are a physical retailer in a video game space that has been primarily switching towards digital, especially with the pandemic, making it so that why would you go and risk getting, the virus when you could just buy the game digitally and cut out the middleman in GameStop. And so that's one of the main reasons why GameStop has been struggling so much in the past couple years, has been the move to digital. And as you'd expect with the revenue falling, net income has also been falling, so the company is not in a great spot. But at the end of 2020, we saw some movement in the way the company was operating that was pushing the company in the right direction. The first one that came out had to do with Ryan Cohen, formerly of Chewy, coming in and saying that he wanted to see some major changes to the overall company. And then a couple days later, he came out and said that he wanted GameStop to become the Amazon of the video game space. And the stock jumped a lot because of it, but it's very interesting to see if people actually think this is realistic because I'm sure pretty much every physical retailer would want to be the Amazon of their space, but it's easier said than done. And then the other big news story that happened, I think it was back in November, was that they announced that they were having a deal with Microsoft that would give them a percentage of all the digital sales that happened on consoles that were sold through GameStop. While the numbers haven't been released, the rumors have been between less than 1% to 5%. So it's not going to be, like 50% of the sales, but it's a number that will push the company in the right direction and will give them more digital sales going forward. So that's kind of what's been moving the stock around. It's just this optimism that Ryan Cohen's going to come in and be able to restructure the company in a way that's going to set them up for success in the future. And that's one of the main reasons why this company has been able to retain a lot of its stock value, because people are actually optimistic that the company will be able to rebound. And as they say, we like the stock. So let's talk about the actual earnings report, because the numbers that actually came out weren't that important to most investors. I'm sure it would have been great if they had a blowout quarter and had some really impressive numbers, but that's not really what people were looking at. I will say that they did miss on the top and bottom lines, but actually not by that much. I saw some headlines when I was watching CNBC of an analyst saying this was a horrible quarter for GameStop. You can nitpick. You can find numbers that looked really good that I'll talk about in a bit, but you could also find numbers that weren't great. But the thing that people really wanted to hear about was their plans for restructuring and the potential of a share offering, because usually when you have companies that go through a major increase in value, the company sells more shares because it's a great way to pay off debt or allow a company to restructure in the future. And the restructuring is exactly what GameStop wants to do. And based off of some of the numbers that I ran, I wanted to compare it to NEO, because NEO was a company that had an incredible run in 2020. It was one of the EV stocks that did incredibly well. Then this past summer, they sold a bunch of shares to raise a lot of money. And based off of the percentage of these shares outstanding that they sold, if GameStop did the same thing at the price that it's been hanging around at between 150 to 200 for the past couple weeks, they'd be able to pay all of their long-term debt off or be able to just restructure in a safer way when it comes to the actual financials of the company. But on the actual earnings call, they didn't mention it. The only reason that we know that it was discussed is because someone said that after the call ended, one of the executives mentioned it, but it wasn't something that was actually talked about in the actual earnings report, which I thought was very surprising because I feel like if you have a company that has this once in a lifetime short squeeze and it's been able to retain most of its value, you need to be selling shares to set yourself up for success and not have this just be a one-off thing, because if the stock price goes up and nothing changes, it doesn't put the company in a better spot to succeed. And this could be a fantastic jumpstart for the company to restructure and actually do well for the next decade plus, because right now they're just hemorrhaging money and not in a great spot. And there's a lot of optimism, but the way they handled that earnings report yesterday, I'm not super happy about it. And going along with not actually talking about the share offering during the presentation, they didn't mention anything about a restructuring plan and they didn't answer any questions. So it was a very questionable earnings report from them. The only good thing that they said is that they added former Amazon and Google executive Jenna Owens as their new chief operating officer. So obviously whenever you bring in someone from Amazon and the goal of the company is to restructure in a way to become the Amazon of the video game space, that it sounds like a good trend to be going. And so it's very interesting because Ryan Cohen coming in and saying that he wants to restructure the company is a positive thing, and he's been put on I believe it's a task force by the company because he just owns public shares. But as of right now, this is about all he can do. He has been a very vocal bull and a reason why a lot of people have been on board with this restructuring kind of dream of GameStop. But as of right now, the company has not done a great job at reflecting these changes that they're actually doing with the company. They seem like pretty much any other brick and mortar store that we've heard of from in the past year with the pandemic, the fact that they're struggling and they have seen a boost in online sales. But I want to give some of my initial thoughts on it because I will say that this is probably one of the most anticlimactic earnings reports we've had in the past year. This is a company that has been the talk of the town for pretty much the investing world and even the non-investing world. The fact that GameStop was trending on Twitter and it was become a pretty common understanding of what actually happened. And then they didn't really talk about any of the things that people wanted to hear. There was the link to actually get into the GameStop call for investors. I know it's completely full. And then they were underwhelmed with the information that was actually given. There were some positives like the potential share offering, even though that wasn't talked about during the actual earnings report, and the adding of a former Amazon executive, which is fantastic. But most of the questions that we wanted to know weren't answered. E-commerce sales did jump 175% last quarter, which is a step in the right direction for a company that's trying to focus on e-commerce sales in the future, so that is positive. But I'm pretty torn on this actual report because I do understand why both short and long-term investors would be kind of upset with the overall earnings report, because if you're a short-term investor, you would want a boost to optimism with the potential restructuring plans or just an incredible beat on the numbers that would push the stock price up significantly in the short term. And then for the long-term investors, you just want to hear about their plans for paying off the debt, a potential share offering, and just restructuring the company. And I feel like no one was really happy with the numbers that came out yesterday. And it kind of makes sense why the stock price has fallen off significantly since that point. But I am still pretty impressed that it's retaining a lot of its value even after this bad news. Okay, so let's move over to Adobe stock, ticker symbol ADBE. And I did have a quote from one of my previous videos talking about if Adobe fell after their last earnings report, I would be buying more. And then it didn't move at all, 0%. I was pretty surprised by that. But so the things I wanted to hear with this earnings report is I wanted to see very nice revenue growth. I wanted to see a boost to guidance. And I wanted to hear more about the CRM product that they're producing with AI with Microsoft. And based off of what I saw, the long-term bull case for me is still intact. And I feel very bullish on it. And I feel maybe even more bullish than I was in the past. So let's talk about some of the numbers, because with a stock like Adobe, you're expecting some impressive growth, and those are the numbers that we saw. They had net income of $1.26 billion, which was up from $955 million a year earlier. They had revenue growth of 26%, up to $3.9 billion, with their digital media revenue being up 32% year over year. When I've shown the revenue growth for Adobe, it's incredibly impressive. And so seeing these type of numbers and the fact that they had 26% revenue growth for a company that's been around since 1986, it's so impressive. That's why I love Adobe for a long-term investment, just because it's incredibly reliable when it comes to their long-term growth of their stock price and their revenue. And so they had a great quarter, and then they even boosted their guidance that was above expectations from Wall Street. They posted guidance of $15.45 billion for their fiscal year, which is a nice boost from their 2020 fiscal year of $12.87 billion in revenue. So they boosted their outlook. They had fantastic numbers. And when you look at the charts, so impressive. And so I wanted to talk about a chart that I've never really shown on this channel, but I think this would be a good time to kind of introduce it to people that have been watching these videos. And we're going to be talking about a logarithmic chart. And so log charts don't make the most amount of sense if you don't actually understand what you're looking at. But the idea is that when you're looking at a company for a long-term position, if you look at the all-time chart, it looks like the stock price has skyrocketed significantly in the past couple years because a company could have started, maybe the last decade between like $10 and $15, and then all of a sudden it's up to $60, and that looks like a huge jump in price. But what the logarithmic chart does, it has every interval that's on the y-axis being the same amount of percentage. It's usually a 100% jump. So the difference between a $3 to $6 jump is the same on the chart as a 100 to 200. So it shows the percentage values. And when I show the annual returns for something like an Adobe, this is a better way to visualize it for a long-term position because you can see how the stock has moved relative to other years. So I think the log charts are something I'm going to be using from now on for looking at all-time charts because I think it's a better representation of how the stock has been doing overall. So overall, I'm just as bullish on Adobe as I was before the actual report. And so the numbers that came out were exactly what I wanted to hear. They didn't really mention the CRM product, so I'm expecting that to come out maybe a couple quarters from now, but that is still a long-term bull case for me for Adobe, and I feel very good about it overall. And so looking at GameStop and Adobe, these are two very different types of earnings reports. You have a well-established company like Adobe that keeps beating expectations, and then GameStop was probably the most anticipated earnings report so far of 2021, and they really underwhelmed with the numbers and the future plans that they actually talked about. The fact they didn't answer questions, the fact that they didn't mention how they're going to be restructuring, the fact that they didn't talk about a share offering, it happened after the actual report, has me a little bit worried for a long-term position on GameStop. So I'm very curious to see what you guys thought of the GameStop report. Thanks for watching this video. I appreciate all support, and I will see you in the next video.